everyone, and welcome. If you're preparing for an accounting interview, you've come to the right place. In this series, I'm going to help you understand and master the top 100 questions that are commonly asked in accounting interviews. Now here's the important part. We're not just going to memorize textbook definitions. We're going to understand the logic behind each concept, because that's what makes you sound confident and knowledgeable in an actual interview. So grab a notebook, get comfortable, and let's start. The first 4 questions. Question 1. What is the basic accounting equation? Let's start with the foundation of accounting. The basic accounting equation is assets equal liabilities plus equity. Or simply, what the business owns equals what the business owes plus what belongs to the owners. Let's break that down. Assets are the resources the company controls, things like cash, inventory, equipment, buildings, and accounts receivable. Liabilities are obligations the company owes to other parties, such as loans, accounts payable, and accrued expenses. And equity represents the owner's residual interest in the business. Here's a simple example. Imagine a business has $100,000 in assets. Those assets might be financed with $60,000 of debt and $40,000 of owner's equity. So, $100,000 in assets equals $60,000 in liabilities plus $40,000 in equity. And that equation must always balance. Now here's the interview answer I would give. The basic accounting equation is assets equals liabilities plus equity. It represents the fundamental relationship between what a company owns, what it owes to outsiders, and the owner's residual interest. Every transaction recorded in the accounting system must maintain this balance. That is a much stronger answer than simply saying assets equal liabilities plus equity. You give the formula, and then you demonstrate that you understand what it actually means. Question 2. What are the main financial statements? This is another fundamental question, and you should answer it confidently. The 4 primary financial statements are: Number 1, the balance sheet. This shows the company's financial position at a specific point in time. It includes assets, liabilities, and equity. Think of it as a financial snapshot. Number 2, the income statement, also called the profit and loss statement. This shows revenues, expenses, and the resulting profit or loss over a period of time. This tells us how the business performed. Number 3, the statement of cash flows. This explains how cash moved through the business. It generally breaks cash flows into operating, investing, and financing activities. And finally, number 4, the statement of changes in equity. This explains how the owner's equity changed during the period. So a strong interview answer would be, the 4 main financial statements are the balance sheet, income statement, statement of cash flows, and statement of changes in equity. Each provides a different perspective. The balance sheet shows financial position. The income statement shows performance. The cash flow statement shows cash movements. And the statement of changes in equity explains changes in owner's equity. Notice the structure of that answer. You don't just list the statements. You explain the purpose of each one. That's what makes an answer sound professional. Question 3. Explain accrual accounting versus cash accounting. This is one of the most important concepts in accounting. Under cash basis accounting, you record revenue when cash is received and expenses when cash is paid. Very simple. But under accrual accounting, you record revenue when it is earned and expenses when they are incurred, regardless of exactly when the cash moves. Let me give you an example. Suppose you perform a service for a customer in December, but the customer doesn't pay you until January. Under cash accounting, you would record the revenue in January. But under accrual accounting, you record the revenue in December because that's when you actually earned it. The same logic applies to expenses. Suppose your company receives services in December but doesn't pay the vendor until January. Under accrual accounting, the expense belongs in December. Why? Because December is when the company received the benefit. This is why accrual accounting generally provides a better picture of ongoing business performance. A strong interview answer would be, cash accounting records revenue and expenses when cash is received or paid.
Accrual accounting records revenue when it is earned and expenses when they are incurred, regardless of when cash changes hands. Accrual accounting generally provides a more accurate picture of a company's financial performance for a given period. That's the answer you want to remember.
That's it for now, everyone. See you in the next video to complete the top accounting interview questions.